Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
Good morning. Welcome to Insurance Matchmaking. I don't know if I say changing it up, but I put chat to work again. And it's like, I feel like I just keep repeating myself. It's like, I've probably been beating that drum or beating the proverbial dead horse. But just so trying to structure this maybe a little different, and that's actually kind of funny that's kind of the way it goes, because the title for this show is Stop Comparing Plans, Start Comparing Strategies. And so typically, most of the time, sometimes I kind of come across a little authoritative or authoritarian. Maybe usually try to focus the show especially when it's just me and I don't have a guest, or we're just not informing but more educating. And I believe you've probably heard me talk about the High Deductible Plan G a few times, and so that's going to be kind of one of the subjects. That'll be one of the subjects of this show, but it's not the only subject. I get people always say, Matt, tell me which plan is best. And the truth is that's actually the wrong answer. Really, the better answer is what strategy is best. And that's why, like I said, we talked about that high deductible G. So that's one of the strategies we use. Because Medicare is not really about picking a plan. It's deciding on how to handle risk, cost, and your health care over time. Insurance, and you probably heard me say this before, health insurance and health care are not actually the same thing, but they do end up they have become somewhat synonymous. Insurance is the transfer of risk, or sometimes referred to as the avoidance of risk. So we pay for insurance so that when something major happens, or something happens that would be a big cost, it doesn't hit as hard because we have insurance to soften that blow per se. It's easier sometimes for me to use the comparing with our car insurance, because if something happens, you have a car accident, you weren't planning on paying to have your fender straightened and your car repainted, but when that happens and you had that big expense, or the storm comes through and takes the roof off your house, you hadn't planned on spending thousands of dollars to fix those things. Well, the same thing with our health. But a lot of people think, I don't want to have to pay, a couple $100 when I go to the doctor. I want to have a $10 copay or $20 copay. And those days are kind of gone. A lot of plans, it's, $20 is the minimum on a copay. And some are, $50 and $100 for a specialist, depending on the coverage of that plan. Again, and that's what that's health care. That paying those copays when you go to the doctor, that's health care. That's not insurance. Now, you do get an insurance policy to cover that, but insurance is really for those catastrophic incidences where it's, you get hurt in an accident. And again, when I use the term accident, people I know, your mind probably goes to thinking of a car crash, but they're actually injury policies. So an injury policy pays for you had to go to the urgent care, the emergency room, because you got hurt. That's when I say accident, that's what I'm talking about. But you can have a very serious accident. And I use the example of when I broke my knee. It landed me in the hospital. I had to spend the night there because it was a weekend, and I had to wait till Sunday when the orthopedic could get the one available surgery suite to be able to fix my knee. So I was so it was ambulance, emergency room, hospital stay. That all got pretty expensive. Fortunately, insurance covered that. So that's what I'm talking about, insurance. We want to make sure that we're covering against those major instances, not necessarily paying for every little need you need, whether it's a lab or whether it's a doctor visit. So when it comes to how you handle that, it kind of let me take a step back here. The problem with plan shopping is, most people do. That's what we do. That's what the ads, are directing us to encourage, to compare plans, and we do that. But I guess kind of what I'm getting at there is, let me compare the plans. I'm going to come up with a recommendation of what I think is going to cover you. It's going to meet your needs. So let me do the comparing and then present you with the solution. It's kind of what I'm asking for, because one might have a lower premium. This other one has better coverage, and again, I'm looking at my notes from what ChatGPT gave. We have to be careful about saying better coverage or best coverage. I'm not supposed to compare plans to you. That I can't say. Again, when I'm comparing a Medicare supplement to a Medicare Advantage, we typically say the Medicare supplement is better coverage, and it's not necessarily better coverage. It's going to be more coverage because you are going to have those out-of-pocket expenses. Traditionally, comparing, say, a Plan G to a Medicare Advantage plan, and I always say, a Medicare supplement, you're paying for coverage. A Medicare Advantage, you pay as you go. When we talk about the high deductible G, we kind of do a combination of those two things because they call it the high deductible. I think I've discussed this before. Not really a deductible. It's actually a maximum out of pocket. So there are deductibles involved, and so you have to pay the deductibles first, but those deductibles are going towards that max out of pocket. So any healthcare costs, any cost sharing you're having with your Medicare are going to go towards that maximum out of pocket. And I've always just to keep things simple, right now it's right at about $3,000 for the difference between a high deductible G than the traditional G. But you still have the Part B deductible, and then Medicare pays 80%. So you're paying like a copay because you're paying that 20% for like doctor visits and things like that until you hit that maximum out of pocket. Now, most people in a given year are not going to hit that maximum out of pocket. So you're going to save a lot, year over year. And again, kind of like with the Medicare Advantage. If you don't go to the doctor, you don't have a copay. If you don't have an x-ray, you don't have a copay. So, so those zero premium Advantage plans can be very attractive. But now you're dealing with a network. So that's kind of like I said, to me, the high deductible G is kind of like a hybrid between a Medicare supplement and Medicare Advantage. You have that benefit of no copays, or no networks, but you also have you do have kind of a maximum out of pocket. Again, it's generally quite a bit lower than you would have with a Medicare Advantage, so you're not getting the zero, and you're not going to get the extra benefits that are thrown in. And hey, this next year that may not be a big deal anyway. We are seeing a lot of erosion to the plans coverage with the Medicare Advantage, so could make a Medicare supplement look a little more attractive. But the Plan Gs and even the Plan Ns, those premiums are getting kind of high, and I'm getting, I'm starting to get feedback from some of the people that that I put on a Medicare supplement 4 or 5 years ago, and they get their premium notice, and it's like, oh, it's gone up quite a bit. I've got one for somebody yesterday, and I meant to do the percentage, but the monthly increase was going to be like $40, and I believe this individual, I think she has a Plan F that. Because she's older and has a Plan F, so yes, her premium was going to be higher. But we may need to look and see if we can't get her on a different plan. Now, the high deductible G may not be the right plan for her, but we still need to look at see if maybe we can beat that rate increase. And the rate increases, they're just going to happen. That's what happens with Plan F and Plan G. I was working yesterday, we ended up on like $61 on a high deductible G, where it was going to be with that carrier, it was almost $190, I think, for Plan or for the traditional Plan G. So big, huge difference in premium. Now, the beauty of that lower premium is even if it's the same percentage that's applied to increase to traditional G, the rate, the amount of the rate increase will be much less. But typically, also that rate increase is usually a much lower percentage. So we're going to look at, like I said. So we're looking at plans, what's the lower premium, what's the better coverage, which one has dental or vision, and all of that matters. But it doesn't answer the bigger question, and that answer is, how is this going to work for you long term? And so that's kind of what I'm using on that. And I kind of got in it, you had that predictability with the traditional Plan G. So we're going to talk about, two core strategies, and I got to keep watching on my time here. I've been running into the break in the last few shows, so I want to make sure I'm conscious of the time. And this presentation here, I think, is going to bridge into another episode. I don't think I'm going to be able to finish it today, just because of a lot of what I'm covering. And then again, in the second half of the show, I may end up go through things a little quicker. But we're getting close to the break, but we're not quite there yet. But with Plan G, you are going to pay a higher monthly premium, but you're going to have very little out-of-pocket costs. You're going to have that Part B deductible, which, as we're recording today, it's 2026, and that's $283. So my guess is, just to use round numbers again, like I said, it's $283 right now. It's probably going to be right around $300 in 2027, and I don't know. It could be, it could go to $290. It could be $294. I don't know the numbers, but it's going to be closer to $300 than it is now. So, if it's not 27 and 28, I'm sure it's going to be above $300 a year for the Part B deductible. But again, as I said, that's predictable. You're going to have a monthly premium. You may have a rate increase, but when they give you that rate increase, you're going to have that rate basically until the next year, to the next rate increase. And then you're going to have that Part B deductible. Once that's paid, your Plan G pays 100% of your expenses to the end of the year. And, of course, that deductible starts over. And I say 100% of your expenses, your Medicare-approved expenses. Your Medicare supplement won't pay anything if Medicare doesn't pay it. And there's a couple things out there sometimes that are exceptions, but as a general rule, I just don't want you to get the impression of, Medicare's not paying for this, my supplement will. No, they're going to do the approved Medicare costs. Now, some carriers will have some little add-ons. I don't know if I want to use a name, but one of our plans has a rider that goes on their plan, and it will cover some of the things that Medicare won't cover because it doesn't meet their timeline. And the easiest example on that is like colonoscopy. Medicare says, and it's like minimum every 5 years. Sometimes you may have a doctor that wants you to have one maybe every 2 years. So Medicare's not going to cover that as a preventive care. And so they could come back and say, nope, it's not within the 5 years. That's not a Medicare-approved expense. And if that happens, your Medicare supplement's not going to cover it either. But the one company I have that has that preventive rider, it runs you about $10 a month. As long as that colonoscopy is coded as preventive, then they will go ahead and cover it. The thing is when if they find a polyp, that's a surgical procedure, and again, that would be, as far as I know, it's going to be subject to the deductible. I think Medicare would still cover that portion, but they wouldn't pay for the actual exam itself. It's kind of weird, and again, generally Medicare pretty much covers everything medically, but there are certain, an annual physical is not covered. There's certain tests that are only, they're only approved a certain amount of frequency. So, like I said, the Plan G, it's predictable, and that peace of mind is worth it for some people. I've talked to some people, especially that they're older and they can pass the underwriting to, because their Plan F that they got, 10 years ago is just so high now, we can switch them to another carrier and get a lower premium. They're so used to paying their premium and never having a doctor bill, they don't want a Plan G. They don't want to have that. They don't want to have to pay the deductible. They just would rather pay more in premium and have that peace of mind that they know they're not going to get a doctor bill. And then some people are like, oh, yeah, give me the Plan N. I'm okay at paying, getting a copay every time I go to the doctor. I've been doing that for 40 years while I was working. So, and you get that lower premium. So those are some of those trade-offs. Now, the thing is, with the high deductible G, you're going to have a much lower premium, but you are taking on more risk because you have that about approximately $3,000 of costs. Now, the biggest cost on that's going to be is a hospitalization, because Plan G, the traditional Plan G that has just, you only have to meet the Part B deductible, it covers the Part A deductible, which is a little over $1,700 right now, $1,726, I believe is the exact number. And so if you're admitted in the hospital, you don't have to worry about that deductible if you have a Plan G. Now, if you had only Medicare, that $1,726 deductible is not an annual deductible. You go into a hospital a couple of months after another, 2-3 months after you've been in the hospital, you could have to face that deductible again. That's why we always say, we never recommend that you only just have your original Medicare. And of course, you have to have Part D coverage, or there's a penalty for not signing up for Part D. So we try to make sure we get those bases covered. So you are at risk for that approximately, and you might as well say $2,000 hospital deductible, because that deductible goes up every year too. So we're getting close to hitting that $2,000 mark for that. So one of the strategies that we've been using, and actually Elijah and I both yesterday utilized this strategy, so I think it's going to kind of become a norm for our office, is recommending a high deductible G and adding a hospital indemnity plan. I heard somebody refer to local recently as your copay protection plan, and I kind of want to get used to that, because we never recommend a Medicare Advantage without that copay protection, and also that cancer, heart attack, stroke protection, because those are the big expenses that would make you hit the maximum out of pocket on those plans, because that's what you're doing with the Medicare Advantage, just kind of like what you are with the high deductible G, is you're taking on less monthly costs to not have to pay bills. But the thing is, you have a bad year, you're going to have some big costs. All right. And wow, I went way over my break time. I told you I was going to watch it. So we'll be back right after this.
Why go to two companies when one will do? Bundle your home internet and your wireless service with one local company that does both. Twin Lakes Fiber Internet plans start at just $34.99 a month. And when you add Tri-Lite Mobile, your first wireless line is free. That's blazing fast internet speed at home, nationwide mobile coverage on the go, and one local team taking care of it all. Visit twinlakes.net or call 800-644-8582 to learn more today.
Join Habitat Restore at their pop-up donation event every second Saturday of each month at First National Bank in Sparta. The Habitat team will be there ready to go to receive your donations. So don't miss an opportunity to declutter and make a difference at First National Bank in Sparta with the Habitat Restore pop-up donation event every second Saturday of the month.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
All right, and we are back with Insurance Matchmaking, and I was talking about taking on that little bit more risk, but we do have a way to avoid that, a lot of that risk too, and that's kind of what we're going to get into. I talked about the hospitalization plans. So some of the plans we can just request a lump sum payment for a hospitalization. There's others that will pay a small payment per day and then add a lump sum. So we have to structure it depending on which company we're going with. We structure it a little differently, but basically we're looking at covering about $2,000 of hospitalization cost, because those are the things that are going to probably hit you the most. And then we always recommend, at least cancer protection if we can do that, or heart disease, heart attack protection. Now, some people can qualify for one and not the other. Generally, the cancer one it's actually pretty simple to qualify, and depending on the plans. Now, there are some companies that will be picky about your height and weight or other health conditions, but most of them it's going to be, have you had cancer in the last 5 years? That's the biggest one there. And if you haven't been treated for cancer in the past 5 years, then you should be able to get a cancer plan. And we always recommend that with an Advantage plan, that in the hospital plan, because you're going to have those out-of-pocket expenses. So we kind of take the approach on the high deductible G like we do with the Medicare Advantage of, hey, we need to protect against those out-of-pocket expenses. Let's go ahead and put in place a hospital indemnity plan, and a cancer heart attack, we call a CHAS. Put those in place, because the neat thing with those plans is they don't go up as you get older. Your Medicare supplement does, but that's the beauty of the high deductible G, is it's going to be a lower percentage if they even have a rate increase. Maybe they have, say, a 5% rate increase on Plan G. They probably won't even have any rate increase on a high deductible G. Past year we've seen some double digits, 15 and 18% increases on Plan G, and most of the companies that did that had maybe an 8% on the high deductible G, or even less. So And again, you're starting at a much lower premium, so that's going to have, so your rate increase on your high deductible G is going to be a lot less than the traditional G. And then those companies, like I said, they lock in the rate on the hospitalization and the cancer coverage. Now, the cancer coverage, some of them do have a recurrence benefit, but the most they're going to pay out is for 2 episodes of cancer. God forbid, hopefully you don't have a third go-round of cancer. We hope you don't have one, and we definitely hope it doesn't hit a second time. But it does happen, and so some of those that have that built-in recurrence rider, or we add that rider that would pay again if you were diagnosed with cancer again or a different cancer. And sometimes they're not the same, and so it would trigger a payout. But the hospitalization one, those benefits reset. So now when we do like the lump sum, it's going to reset annually. The per day in the hospital plans, that part will reset for another hospitalization. If you have the high deductible G, you're not going to have the out-of-pocket expense once you've hit that max out-of-pocket for the year, so you won't typically have to worry about that. But it does reset annually. So you go in the hospital, say in January, and it pays out $2,000, and you're fine for the rest of the year, and in April of the next year you end up in the hospital again, it would pay again. Or maybe I should have backed up and said, hey, you went in the hospital in December and used your lump sum hospitalization, and then in February you got admitted to the hospital again. Those are 2 separate years, and it would pay out again. It's not a lifetime max; it's an annual benefit. And then you can have outpatient surgery that'll pay so much on that. And a biggie on that, one thing I like about the plans that have the outpatient surgery rider, it's usually twice in a year. And I always tell my senior clients is, you know why that is, because you have 2 eyes. And probably the most common, you have 2 eyes and you have 2 knees and 2 hips. And those surgeries a lot of time happen in pairs, because they're not going to do them at the same time. You're not going to get 2 knee replacements at once in one surgery, because you won't, you might not be able to walk. You have to be able to recover one knee and then the other. Now, it's been done. I have heard of people getting both knees done at one time. But cataracts, they always do it. You have one done, and then maybe the next one's a couple of weeks later. So it gives that eye a chance to heal. But those are 2 separate surgeries, and that's why most of the plans that will reimburse for an outpatient surgery will pay something, twice a year. So those are the ways you may hit that maximum out of pocket on that high deductible G. Cancer's probably the worst one, because that's where you're going to have big expenses. But again, that's when you might have that bad year. But generally, a bad year is going to be 1 or 2 hospitalizations, cancer, or, major surgery. You're going to have those big expenses, but then the rest of the year, your health care is going to be covered because you've hit that maximum out of pocket. So that's the beauty of using that high deductible G strat. It's not the high deductible G strat, or maybe I guess I could call it, but it's that strategy of pairing a high deductible G with a hospitalization and a cancer plan. And the reason I bring those up is when you're turning 65, one, you can't be turned down for a Medicare supplement, no matter what your health is. You have a 6-month window where they have to accept you for a Medicare supplement. That's the same as true on that, or somewhat true on what we call the hospital indemnity plans, or the HIPs. Not the hip at your waist, but the HIP. So we like our acronyms. But a HIP plan will generally is guaranteed issue also at that age 64 and a half. Some of them, I got one carrier that goes from age 60 to age 79 on a guaranteed issue on a hospital indemnity. And it also includes up to $10,000 of cancer coverage. It won't, if you currently have cancer, it's not going to pay anything for that cancer, but you can still add that rider that would pay for if you got cancer for another one. So you don't have to have that 5 years for that one. But if you want more cancer coverage, then you have to be able to at least answer that question, know that you have been diagnosed or treated for cancer in the last 5 years. And in the hospital indemnity plan, it's going to be guaranteed issue, but there are going to be some pre-existing condition limitations. And it can range generally from 6 to 12 months, depending on the carrier, that if you end up in the hospital for a condition that you already had, they're not going to pay right away. But if it's something totally separate from a pre-existing condition, it will cover it. And it goes back to, like I say, an accident. If you get hurt and end up in the hospital like I did with my knee, that's going to be covered because that had nothing to do with pre-existing condition. It was an accident. I slipped, I fell, busted my kneecap. I had no control over that. If I'd had control, I wouldn't have broke my knee, right? But it had nothing to do with whether I was taking care of my health or not, is the point I'm making. So that's where that hospital indemnity plan, and you can get those hospital indemnity plans at any age. Some of them work better, again, a lump sum for a hospitalization because high deductible on a Affordable Care Act plan, but and you have a high maximum out of pocket on some of the Medicare Advantage plans are very high max out of pocket. So the strategies, and again, sometimes on that, hey, zero, and then it still may be a zero premium, and then you have plans that have, the advancement have that what they call the give back. I used to hate those plans, and you probably heard me talk about that in the last couple of weeks. I used to hate the give back plans because they were like, oh, we're going to give you $50 and pay on your Part B premium, but your hospital copay is going to be $150 more per day than on our plan that's not a give back, and the maximum out of pocket is $3,000 more. Is that really worth $50? So, but some of the plans have gotten a lot more generous on that give back, and yes, they do cut back on, say, the dental benefits or the over-the-counter benefits. The maximum out of pocket and the hospital copay are going to be higher, but if we're covering that with the indemnity plan, you're good to go. And the thing is even if you get an indemnity plan with a Advantage plan and you decide later, you want to get a Medicare supplement, they would still pay out. And that's why I say you don't have to be Medicare age to get a hospital indemnity plan. We can do one and kind of structure how it would work with a Medicare Advantage when you do turn 65. I've done that for a few couples. Is like usually what happens, I'm working with one spouse that's turning 65, the other one's 62 or 63. They're on Affordable Care Act plan, but we go ahead and write the hospital indemnity to fit the Medicare Advantage that their spouse took. In my past life, as I used to say, I spent more time writing Medicare Advantage plans. So it looks like I'm getting close to running out of my time here, so I don't want to rush my closing. And like I said, I think there's some more things I may touch on. I think I have to look at my notes here. I maybe covered them, in the same segments. But keep listening to us here at Grace 107.7 every Saturday at 10. Insurance Matchmaking, brought to you by Matt Libby Insurance. And we don't sell you policies, insurance policies. We match you with the policy for you. And that really plays into the strategy we're talking. We don't want to just compare plans. We want to develop a strategy for you. And everybody's different. Every couple's different. I mentioned the one yesterday. The application that I did was I wrote the husband 2 years ago. He's had some health changes, and so I wasn't able to apply some of the strategy I did for his wife. But we put in some really good, robust coverage, and we used our High Deductible G strategy. So again, keep tuned to Insurance Matchmaking, and we'll talk again next week.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.